Today, how much debt is too much? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. And in our daily review of everything important that's happened today, we delve more deeply into the continued debt mountain that's being laid out before us from all the central banks in many different countries, and consider some of the implications and consequences, even as some of the banks here in Australia now start to extend some sort of hand towards customers in difficulty. And we start with a pretty startling announcement from the Fed when they said that they were going to extend the US dollar swap lines to 9 additional countries. Now, US swap lines are where central banks in other countries can swap money in their own currency with the Fed in US dollars. So basically it's a way of flowing US dollars, in other words US dollar liquidity, back into those individual countries. So it's a sign of potential stress in the system. And I'm just reading some material here off the DFA blog. The US dollars have been in huge demand and tight supply in markets outside US borders as banks, companies and governments scramble to secure them to service the dollar-denominated debts many have accumulated. That has sent dollar funding costs spiralling and has led to a historic run-up in the dollar's value against other currencies. The new facilities total $600 billion US dollars for central banks in Australia, Brazil, South Korea, Mexico, Singapore and Sweden, and $30 billion each for Denmark, Norway and New Zealand. The swap lines will be in place for at least 6 months. And this is a combined total of $450 billion US dollars, money to ensure the world's dollar-denominated financial system continues to function. Those countries were given swap lines during the 2007 to 2009 crisis, and the Fed has permanent swap arrangements with the Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank and the Swiss National Bank. The Fed said that the new swap lines, like those already established between the Federal Reserve and other central banks, are designed to help lessen strains in global US dollar funding markets, thereby mitigating the effects of these strains on the supply of credit to households and businesses, both domestically and abroad. And US dollar credits to non-bank borrowers outside the United States grew by 4% year on year to the end of June 2019 to reach $11.9 trillion US dollars, according to the Bank for International Settlements. Making dollars available to foreign nations, even if it doesn't cost the Fed, became a point of contention for some in the US Congress, says Bloomberg. The central bank had to repeatedly defend the action and explain to lawmakers that US taxpayers were not lending foreign nations money and that because they were swaps, not loans, there was no risk of default. And echoing that news, the Reserve Bank in New Zealand announced that they were going to establish a term auction facility to support the markets and banks, a foreign exchange swap funding arrangement, and a $30 billion US dollar swap line from the Fed. That's the one we just mentioned. They also removed the credit tiers for ESS account holders, all signs of central bank support for the financial plumbing. And the Reserve Bank of New Zealand went on to say that New Zealand's financial system remains sound with strong capital and liquidity buffers. Assistant Governor Christian Hawkesbury said that the Reserve Bank is actively involved in financial markets to ensure smooth market functioning. Despite the global uncertainty, regular market operations continue to ensure that there is ample liquidity in the financial system. The measures we are implementing today provide additional support to domestic financial markets. We will ensure our operations make financial markets operating smoothly. We are working in tandem with the banks, the wider financial market community and the government. The term auction facility is a program that will alleviate pressures in funding markets. The TAF gives banks the ability to access term funding with collateralized loans available out to a term of 12 months. Banks currently have robust liquidity and funding positions and can manage short-term disruptions to offshore funding markets. The opening of the TAF will provide confidence that the Reserve Bank stands ready to support the market if needed. And they concluded, the Reserve Bank has a number of tools to provide additional liquidity and the ability to increase the size of operations where needed. We are committed to using these to support smooth market functioning. In addition to the tools listed above, the bank has an established role to provide liquidity in the New Zealand dollar foreign exchange market in periods of illiquidity or dysfunction, and is operationally ready to undertake this role if required. Now, in yesterday's post, I'd already covered the Reserve Bank's speech from the day before when Phil Lowe explained the bridge strategy. In other words, knowing that we are going to go through a period of disruption in Australia, they are building a bridge to the other side. And in fact, we're going to hear an awful lot about bridges and cushions, bridges to keep the system going until we reach the other side, however long that may be, and cushions to help reduce the impact particularly to households and businesses. Now, I recommend, if you've got nothing better to do, to go and read Phil Lowe's speech, because it actually does make a certain amount of sense within the context of understanding how a central bank is thinking, which is you have to create more liquidity, you have to support the system, you have to build more debt, and if you build more debt, that means that you can support households and businesses for longer and more deeply, and that will stave off the problem. Except my own view, as you know, is that building more debt in the system just builds a bit of problem for later. But there you go. That's how central banks are all thinking at the moment. So I'm not going to go into more detail with regard to Phil Lowe's speech now, but you can find it via the link on the DFA blog if you want to go and have a look. But what I do want to highlight is what the Bank of England announced overnight last night. And that is that they have cut the interest rate, the cash rate, to 0.1%. And they also announced an additional £200 billion of quantitative easing. Now, they said the role of the Bank of England is to help meet the needs of UK businesses and households in dealing with the associated economic disruption from the current health issues. And then they recounted the previous actions that they'd taken, because at a special meeting on the 19th of March, the Monetary Policy Committee judged that a further package of measures was warranted to meet its statutory obligations. It therefore voted unanimously to increase the Bank of England's holdings of UK government bonds and sterling non-financial investment grade corporate bonds by £200 billion to a total, an eye-watering total, of £645 billion, financed by the issuance of central bank reserves, and to reduce the bank rate by 15 basis points to 0.1%. The committee also voted unanimously that the Bank of England should enlarge the TFSME scheme, financed by the issuance of central bank reserves. The majority of additional assets purchased will comprise UK government bonds. The purchases announced today will be completed as soon as is operationally possible, consistent with improved market functioning, and the bank will issue further guidance to the market in due course. The next regularly scheduled MPC meeting will end on March the 25th, with the minutes published on the 26th of March. And the minutes of today's special meeting will be released at the same time. So, more stimulation, dramatic stimulation from the Bank of England. Now, the next piece of news I want to discuss tonight is the announcement that the banks made providing relief for small businesses. Australian banks will defer loan repayments for 6 months for small businesses who need assistance because of the current health issues. Australian Banking Association CEO Anna Bligh today announced a small business relief package from Australia's banks. This assistance package will apply to more than $100 billion of existing small business loans, and depending on customer take-up, could put as much as $8 billion back into the pockets of small businesses as they battle through these difficult times, Ms. Bligh said. This is a multi-billion-dollar lifeline for small businesses when they need it the most to help keep the doors open and keep people in jobs. banks are putting in place a fast-track approval process to ensure customers receive support as soon as possible. Australia's banks have supported the country through difficult times in the past and continues to do so. Whilst this is first and foremost a health crisis, this has begun to have serious impacts across the economy, with small businesses beginning to feel the devastating effects. Over the last few days, banks have worked closely with the Treasurer and the government to identify measures to support the economy through this crisis. Small businesses are the most vulnerable part of the economy and have the most urgent need for assistance. Small businesses employ 5 million Australians, and this package is designed to help them keep doing just that. Small businesses can rest assured that if they need help, they will get it. Banks are already reaching out to their customers to offer assistance, and packages will start rolling out in full on Monday. Any small business who has not already been contacted should contact their bank to apply. Banks have developed this small business relief package following discussions with APRA and ASIC to provide the appropriate regulatory treatment, and the package is subject to authorisation by the ACCC. So well done to the banks for at least getting something sorted out. But of course, here's the issue. If you stop making repayments, you still have to repay the capital and you'll be accruing additional interest. So it may work if in fact your business can bounce back post the crisis, but if it can't, then you're just digging a bigger hole for yourself. Anyhow, then the ACCC came out and said that they authorised the bank's small business relief package. They provided urgent interim authorisation to allow the Australian Banking Association and banks to work together to implement a small business relief package. And then banks have come forward to start offering specific help. So, for example, NAB said that they announced a sweeping support package for businesses and personal customers at a time when they need it most. Business customers experiencing financial difficulties can defer their payments on a range of floating and variable rate business loans for up to 6 months. Home loan customers experiencing financial challenges will also be able to pause their repayments for up to 6 months. NAB, which is Australia's largest bank for business, will cut 200 basis points from the rate on new loans and all overdrafts on its flagship digital business product, QuickBiz, effective March the 30th. It will reduce variable rates on small business loans by 100 basis points, effective March the 30th, on top of the 25 basis point reduction announced on March the 13th. And NAB also announced reductions of up to 60 basis points on fixed rate home loans to give customers the option of added certainty. There is no change, however, and this is important, there is no change to home loan variable rates. For depositors, NAB has introduced a 10-month term deposit rate of 1.75% per annum in recognition that the low interest rate environment is hurting savers. This package could provide a potential injection of more than $10 billion into the economy over 6 months, or $380 million a week, depending on customer need and take-up. And NAB CEO Ross McEwen said, "Our focus is clear to support our business and personal customers with their financial needs when they need it most. These measures will provide significant relief to businesses and home buyers over the next 6 months as we all deal with this unprecedented situation." Now, I think some kudos to NAB for doing this. But of course, we still have the same issue that in fact in 6 months' time, you still have a loan and you haven't paid any interest on that loan for 6 months, then the interest will be accruing and therefore the amount that you owe will be a lot bigger. So again, this will be okay if it's a short, sharp dip and then everything returns to normal. It's just at the moment we don't know when that new normal will be in train. And finally, if I may, before we look at the markets, a little bit of unbridled self-promotion, because I had the chance today to speak with Michael Hudson, who's a very famous author and somebody who really understands the issue of debt and how it plays out. And in the show, which I posted earlier on today, the link is shown below, he's discussed in detail the problem with ever more debt. And that is that ultimately debt becomes impossible to pay back. And whilst the banks and the government and the wealthy may benefit from some of the things that are going on with all this liquidity being thrown around, his argument is that the majority of households and businesses are essentially being taken to the cleaners. I think you should watch this show. It certainly gives you a very interesting perspective on what's going on at the moment. So briefly to the markets. So the ASX 200 ended up 0.7% today to 4,816. The financial services index was up 3.56% to 4,075. And the real estate trusts were up 8.94% to 988.20. The volatility index was down 16.28% to 44.29. And the ASX 200 futures was up just 0.05% to 4,955. Among the banks, ANZ was up 5.56% to 15.94. CBA was down 1.71% to 59.91. NAB, who of course announced their package today, was up 6.12% to 15.78. And Westpac was up 7.09% to 15.85. The Bank of Queensland was up 1.46% to 5.56. Bendigo was up 5.56% to 6.45. Suncorp was up 4.97% to 8.26. And Macquarie was up 9.27% to 85.06. AMP was down 0.76% to 2.31. Genworth Mortgage Insurance was up 16.19% to 161. McGrath was down 2.7% to 18 cents. And Yellow Brick Road was up 15% to 6.9 cents. Mortgage aggregator AFG was up 12.62% to 1.205. Mortgage Choice was down 1.59% to 62 cents. And CIM, the infrastructure builders, were up 51.15%, an amazing rise, to 1965. The Aussie US dollar recovered a little, up 3.09% to 59.18. The Euro Aussie dollar dropped 2.3% to 1.8188. The 2-year Australian bond was down 8.47% to 0.281. And the 10-year was up 0.43% to 1.176. The gold Aussie cross was down 1.93% to 2,548. And the Bitcoin Aussie cross was up 15.45% to 11,250. And just briefly looking at last night's close on Wall Street, the Dow Jones was up 0.95% to 20,087. The S&P 500 was up 0.47% to 2,409. The financials index was up 2.25% to 323.22. And Goldman Sachs was up 6.76% to 149.49. And the volatility index was down 9.90 to 64.80. And finally, the S&P 500 futures, which is looking forward to the opening tonight, is up 3.92% to 2,482. So I think we can conclude that at the moment the market volatility has eased a little, but think about just how much money has been poured in from central banks around the world, from the Fed, from the UK, from the Eurozone, from Australia, from New Zealand, and in fact many other countries too. This has been a remarkable effort. And of course the question is, will it be enough? Well, we won't know for some little time. And we'll be back tomorrow to give a little bit of an update on what's happened this past week and perhaps think forward to where this may go next week. But in closing, I just want to come back to my central point. Consider this. We are piling debt on yet more debt. It is essentially pouring petrol on a raging fire. And whilst the fire may be getting bigger, it will be harder to control down the track. And I think the question that no one seems to be asking but should be is, how are we going to reverse all of this debt down the track? Because if Michael Hudson is right, the amount of debt in the system is not capable of going to an infinite level. And there is a point when the amount of debt in the system is simply too much debt. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.